Hi, good evening, everybody. It's fantastic to have everybody here. Just like to welcome everybody to our end of year seminar. It's hard to believe that it's going to be December next week, but that is reality. So welcome to the end of the year. Tonight we're really going to talk about the outlook for 2023. We're going to give a little bit of context to that. And I'd like to welcome everybody online as well. Thank you for joining us. It's nice to have you on the call. I have to say it's a lot cooler this evening than it was this morning, so well done for choosing this time slot in this morning. It was unbearable in here this morning, but the message is just as hot as it was this morning. So, so let's get into it. So if you look at the title, the outlook for 2023, RIP, doesn't necessarily fill you with hope, does it? You know, what lies in store? But really the choice that we've got to decide on for next year is, are we facing recession? Are we facing inflation again? Or is there actually a hint of prosperity somewhere in there for next year? So that's really what we're going to delve into tonight. So I think the first thing to start off with is actually just a reminder of why we find ourselves in the situation that we do. And if you really think about the last 2 years, there has been an amazing confluence of factors that have all come together at exactly the same time to create the spiral of inflation that we haven't seen for 40 or 50 years in the world. So we obviously had the COVID response just initially, where free money was dished out, furloughs, everybody had excess savings, no one could do anything with the money. So there was a pent-up demand for goods because everybody had this money that they didn't even have to earn, and they wanted to spend it naturally. And so spend it they did, and there was a pent-up demand for goods. There were supply chain issues. You couldn't get what you wanted. Factories were closed around the world, and prices started to rocket. Obviously, supply chain issues sort of spiraled out of control. We had chip shortages. Then we actually had the post-COVID reopening, where there's now a huge demand for services, restaurants, air travel, hotels, all that kind of thing. Everything that people couldn't do for a couple of years. That spurred another wave of pent-up demand. Then you had the Russia-Ukraine conflict, which was only added to.
Is that a picture of you and me there?
Great inflation, where people have resigned world over, and it's not that they really don't want to work, if they don't want to work at the same position. You've got wage inflation really rising, and people have realized that maybe there's a difference or a different work-life balance. And then you've had, in addition to that, China's COVID policy, and we're going to talk a little bit more about that later, but it really is a very disruptive way that they're handling things over there. But they're still having lockdowns, they're still having supply chain issues in China. And on top of it all, we've got this desire to go green, and the impact of going green, and the demand for some commodities. All these things have just conspired to get into one big melting pot. And we've got inflation, as I show on the right-hand chart there, and we haven't seen this kind of inflation for, well, the chart goes back 30 years. So I've actually included South Africa's inflation there, which is the green line, because I think it's important also to put in context where we sit in the global economy. So our inflation is 7.6%, and it's very much in line with where the US is, and well below where Europe is and where the UK is. So you know, I think sometimes it's just worthwhile keeping in context where we sit in the whole world. So that's basically why we're here. The problem is that the typical response to higher inflation is to raise interest rates. And these two charts are both quite important from the point of view that the chart on the left really gives you a historic perspective of where interest rates are now relative to where they've been over the last 20 years. And as you can see, interest rates really haven't been this high since the financial crisis. It's actually hard to believe that the financial crisis was 15 years ago. I was doing a presentation up at Michael House a couple of months ago to the boys, and I was talking about 9/11 and the financial crisis, and they all stared back at me blankly and had no idea what I was talking about. And I realized that they weren't old enough to remember those things, which made me feel very old. But really, we haven't had this sort of situation since 2007. But the chart on the right is equally important, and the chart on the right basically just takes America, and it looks at all the time that they've raised interest rates over the last 40 or 45 years. And it basically measures the pace at which interest rates are rising. And so if I just sort of point out this bubble here in American interest rates, when they started raising interest rates in 2016, corresponds with this orange line at the bottom here. And so basically in 2016, America started raising interest rates. They thought that the financial crisis was far enough in the rearview mirror. And they raised interest rates by 2.25% over 3 years. Now that's a very slow pace of raising interest rates. In contrast, this year, we have had close on 4% in 8 months. And so if you just contrast those two extremes, 3.5% over 3.5 years, very, very gradual, very, very steady. And now we've had, we're going to have probably 5% over 12 months from America by the time this cycle is finished. And that really is quite a dramatic increase in interest rates. It's the fastest pace of interest rate increases that we've had probably in most of our lifetimes. And why is that important? It's important because interest rates generally take 6 to 8 months to come into effect. So the first interest rate increase was in March. And if you take that period, then that first increase, which was only 25 basis points, 0.25%, only really started to have an impact now in September, October. And yet, we've had since then, we've had another 3.5% of interest rate increases, and we've got more still to come. So the impact of all these interest rate increases has sort of really yet to be felt, and it's only going to be felt over the next sort of 9 months. And so the consequence of higher interest rates is that the one probably big consequence that's really affected us all is that the dollar has become really, really strong. So what happened when America raises interest rates? It's the first thing is that because interest rates have been so low for so long and no one's been able to earn any interest on their money, as soon as America started raising interest rates, and they were the most aggressive out of the major economies, all the money started flooding into America because now you can actually get some interest on your money. And in addition, people are concerned about a recession. It's an uncertain time. So you go and seek out the haven or the safety of the US dollar anyway. So for two reasons, everybody rushed into US dollars. And you can see this is an index of the US dollar on the left-hand side. You can just see how strong the US dollar's got. It hasn't been strong since basically 2001. But then as a consequence, because remember that currencies are just a seesaw, so one side is getting really strong, the other side is getting really weak. And all other currencies around the world really have come under enormous pressure this year, including the rand. And if you really think about how it really, the transmission mechanism works, is that the dollar gets really strong, the rand gets weaker. We obviously have to import a lot of things, especially oil. Our petrol prices go up, our inflation goes up, our interest rates go up for no other reason than the dollar's really getting strong, and our interest rates went up again this afternoon. So that's how these things have an impact on us all. Even though it's happening in America, and America is a long way away, these things feed through to all of us, and they get transmitted around the world at, unfortunately, breakneck speed. And the other implication of higher interest rates and the strong dollar is that equity markets generally come under pressure. And we've talked about this before, but the main reason for that is that one of the inputs into valuing shares is your interest rate. So when you try and come up with a value for a share, one of the variables that you use is the interest rate. So as interest rates rise, the valuation of shares comes down because the model basically spits out a lower number. And so you can just see the inverse relationship. When interest rates are falling, generally valuations move higher, and obviously vice versa. And that's really the impact that the higher inflation and higher interest rates has had on the world. So if we look forward to 2023 next year, probably the key issue for all of us is what's going to happen to US inflation, because that's going to be the pivot around which everything else really centers. And the good news is that US inflation is already rolling over. So it peaked, as you can see, a couple of months ago on headline inflation at close to 9%, and it's already fallen down to 7.7%. And we are pretty confident that by this time next year, US inflation is going to be sort of 3.5%, significantly lower than where it is at the moment. And you can sort of say, well, why do you say that? What's the basis for that? Well, there are a lot of things that we look at in inflation that are already trending over, and a lot of things that have driven inflation high in the past that are no longer as prevalent. So housing costs are coming down enormously in the US, and that's 40% of their inflation basket. Medical costs are also coming down. They have a rather strange way of calculating medical inflation in America, but that's coming down significantly. Used car prices, funnily enough, are one of the major sources of inflation in America. And just like here, used car prices are, well, in America, they're coming down very sharply. in response to the fact that new cars are obviously the supply chains are normalizing. There's not such demand for new cars. So we are pretty confident, and also obviously oil prices and commodity prices have come up a lot. I was just saying to everybody this morning that the rand oil price is back at levels that it was before the Russian invasion of Ukraine. So you can just see, obviously, commodity prices come up, and we are very certain that US inflation is going to be back at sort of 3.5%. The implication of that is that interest rates in America, we can see the peak in interest rates. We haven't got to the peak yet. Interest rates are still going to go up a little bit further. That's been pretty well telegraphed. But this is basically showed the sort of trajectory of US interest rates over the next sort of 12 or 15 months. And you can see that relative to 6 weeks ago, there's two things that have changed. The first thing is that the peak in interest rates is going to be higher than what we previously expected. Previously, the market expected 4.5% to be the peak. Now it's going to be closer to 5%. But that's pretty much been very well forecast. The market understands that, it knows that, and it's not going to be a surprise when US interest rates get to 5%. But the other thing that's happened is that the pace of declines has accelerated, and the market is already saying that by the end of next year, or towards the fourth quarter of next year, interest rates could well start falling in America. And that obviously sets the tone for everywhere else. Because our Reserve Bank would certainly feel a lot more comfortable if America wasn't raising any interest rates anymore to keep our interest rates unchanged as well. It's a bit of a vicious circle. If we didn't raise our interest rates, we have a real danger that the rand really starts to weaken, which then fuels its own inflation. So the Reserve Bank is slightly got its hands tied behind its back, and it's got to follow a little bit of the global tune. Otherwise, we actually end up being in worse trouble. Now, I just want to go back a slide and talk about the dollar again here. And you can just see in the last couple of weeks, so basically what's happened in the last couple of weeks, we'll come back to it a little bit later, is that American inflation came in much better than expected. It was expected to be 7.9. It was only 7.7. It doesn't sound like a big difference to everybody out there, but to economists and financial people, that's a massive difference. We get very excited about that. And so inflation is a lot better, and that started to change the narrative around what the projection is for American interest rates. And you can see that the dollar's already started to weaken. And the rand is, I think it's 16.90 or 16.95 today. It was 18.60 probably 3 or 4 weeks ago. So you can just see how quickly things change. And as I said earlier, the rand price of oil is cheaper now than it was before the Ukraine invasion. So we should see falls in petrol prices, which obviously start to have positive impacts down here too. But it's too early to get completely excited, because while the US is the center of the whole universe, everything revolves around the US when it comes to finance. Unfortunately, things in Europe are not looking quite so rosy at the moment. So Europe has got exactly the same issues as America's got. They're just about 6 months behind the curve, and their inflation is obviously going up. It's been massively exacerbated by the energy crisis caused by the Russian invasion, and so Europe is going to follow the same path as the US eventually, but it's not going to happen in quite the same timeline as we're expecting in America. And you can see the same chart on the right-hand side there for US or for European interest rates. The shape of the chart is completely different. Interest rates are rising, and they're certainly not falling over the course of the next 18 months. So that's obviously a concern. And then China remains an enigma. That's the best way to describe it. So if you just really focus on the chart on the left, and I think sometimes it's quite just put in perspective, that's China's GDP growth. If you remember back to when China hosted the Olympics in 2008, that lovely sort of birdcage stadium that they built in Beijing, and China was growing extremely fast, 10, 11, 12, 15% a year, and they were just holding everything under the sun. But if you just really look at that chart and you just take out the distortions caused by COVID, it's pretty obvious that China's growth rate has been slowing down consistently for the last 10 years. And quite rightly so. When you're a country that size, you cannot keep growing at the same rate. And it's just the law of mass is that as you get bigger and bigger, your growth rate slows down. But there's no doubt that in the last couple of years, China's growth rate has been severely affected by the COVID policy, and there's zero tolerance to COVID, which is still ongoing at the moment. And I was just reading an article yesterday. Basically, Chinese people are watching the World Cup on TV. They're not allowed to go to China. They've been banned from the World Cup, not by Qatar, but by their own government because of their COVID policies. And they're pretty frustrated because They see everybody else out there, no masks, having a good time, and they're starting to wonder why the hell they're not allowed to do the same thing. And there are riots and things breaking out across China because workers are pretty fed up with all these lockdowns and things that continue to go on. And I must say, we're pretty convinced in the office that if COVID had broken out in any other country except China, we probably wouldn't have even had a global lockdown. I think the way they treated their citizens, everybody sort of followed suit. But I think if COVID had started in America or Europe, we would have had a completely different global response to it. Anyway, the problem is, on the right-hand side, is that China's COVID cases is actually soaring at the moment. And so a couple of weeks ago, which actually coincided with America's inflation number, China started, they obviously had their 5-year sort of annual conference, like the ANC does, and obviously the president was re-elected, and the mood towards China was pretty sour. But soon after that, they came up with an announcement that basically hinted that they were going to start relaxing their COVID policies, and the market has taken massive heart from that, because China, even though, China is still the second biggest economy in the world, and what they do has a massive impact on everything else. And so it's very concerning when you see the chart on the right and COVID cases going up again, because you just really don't know how China's going to react. They could come out tomorrow, and there are lots of cities that are in lockdown or partial lockdown, but I think from it's becoming increasingly untenable for China, because their own citizens are getting pretty fed up with it. So it's just something to watch. It's an unfolding story as we go from day to day. So basically, all the implication of this is that there's no doubt that the global engine is slowing down. If you look at leading indicators, and leading indicators are designed to take a whole lot of different statistics, put them all together, and to paint a sort of picture of what's coming 6 to 9 months down the line. And if you look at leading indicators on the left-hand chart there, all those lines are pointing down. It's pretty obvious that where the trend is going. And if you look at manufacturing on the right-hand side, any number below 50 means that manufacturing is contracting. A number above 50 means it's expanding. And so global manufacturing is just really dipping into sort of contractionary sort of phase at the moment. And if we then take it forward to sort of global growth, we can see that generally for the world as a whole, growth is probably 2 to 3% a year across the global economy. But from the little red bars at the end there, you can see that for the next sort of 12 to 18 months, global growth is forecast to be 1.5% thereabouts. Now that is not recession. Recession is obviously contraction in growth outright. Slower growth is not a recession, but it's going to feel a bit recessionary, if you can use that horrible English. And the table on the right just really sort of sums things up. And I think I just want to point your attention to the very top line, which is the US, growing at 2.6% at the moment. It's still growing pretty fast. And the forecast is that its growth is going to slow down to 0.5%, 1% over the course of the next year. So that all sounds pretty gloomy, and we have got drinks here tonight. Maybe you all want to rush across to the bar quickly and pull your drinks up again and have a good slate. But the next chart is probably the most important slide of the whole presentation. And this is basically to say, I want you to ignore the last 8 slides or 9 slides that I've just shown you and focus on this slide, because this is what really counts. And what this slide really tries to do is to put into context what GDP growth means to the markets and what it doesn't. And remember that the markets are obviously, an index is the aggregation of a lot of different companies, but that's not the whole economy. That's obviously only companies that are listed. It doesn't represent the whole economy by any stretch of the imagination. So these charts are identical. It's just one for the US and one for South Africa. And what they really try to do is cumulatively show how much GDP has grown over the period and how much earnings and dividends have grown over that same period. And what's really telling is that, let's just look at America first, because that's a big economy. For the last 22 years, America's economy has grown at 1.9% per annum on average. And yet company profits over that same period have grown at 8%, and dividends have grown at 7.2%. And if we look at the last 10 years, the same numbers are sort of 2% for GDP, 7.7% for profits, and 7.7% for dividends. And I think when it comes to South Africa, this is really interesting, because what sparked me to go and investigate drawing this chart and finding all the data was an article that I read commenting about Zuma's last 10 years. And we all know that there's been 10 last years in South Africa under Zuma and state capture, and how long it's taking us to get back up on our feet. And and we might be plunged into darkness any moment. I don't know what the load shedding schedule is, but look at the stats for South Africa. I don't know if you can see it, it's so small, but I'm just going to read them out to you. Over the last 22 years, our economy has only grown at on average 2.2% a year, and yet company profits have grown at 9% and dividends have grown at 9%. So I can't even read it, I need stronger glasses. But over the last 10 years, this whole Zuma era, where the last years due to Zuma, the economy has grown at 0.9% a year. And we had charts last time showing how our GDP growth is getting slower and slower over the years. And yet, even despite that, over the last 10 years, companies have grown their profits on average by 8% a year, and the dividends have grown by 8% a year. And that is a really, really telling statistic, because companies are not countries, and countries can amble along and not grow. But the whole reason why you invest in companies and you have investments is because you're tasking those companies to go out and find opportunity and to grow and to seize the opportunity and to grow faster than the economy in general. And that is essentially the whole crux of the matter. So these two charts are absolutely fundamental to explaining why you should have investments and why, yes, GDP does matter, and it would be lovely if we were growing at 3%, because then company profits would be growing at 3%. But even if GDP growth stalled with only 1%, companies are tasked with going out there and finding opportunity. And if you invest in good companies, that's exactly what they're going to do. And so the next couple of slides, I just want to take you through two case studies, just to illustrate the point that I'm really trying to say here. So the first is Microsoft, and I've chosen Microsoft because it's our biggest offshore investment. If you have an offshore portfolio with us, you're going to have Microsoft in it, I hope. And listen, Microsoft is a big global company. It's one of the biggest companies in the world. It's certainly not immune to slowing growth or slowing trend, whatever is happening in the world economy. So if you just think what's happening and how Microsoft is being affected, is weaker global growth. There's chip shortages, so people can't make PCs and laptops. That means you can't sell your Windows software. You're not selling lots of Office software and all the other bits and pieces that go along with it. You've got high labor costs, especially for talented people. And in America, they've had to really up wages a lot for talented people. You've got the strong dollar, so everything, all the money that you earn outside of America is being translated into dollars and obviously coming to less. Importantly, you've got a slowdown in gaming. So during COVID, everybody stayed at home, no one went out, and everybody took to video games like you can't believe, and gaming soared in popularity. But now that people are discovering that there's a world out there again, and it's actually quite nice to get out and go and smell the roses, literally, there's a massive slowdown in gaming. And Microsoft is affected by that. It owns Xbox and all the things affiliated to that. And then you've got higher interest rates as well. So, you know, borrowing is more expensive. All these things are weighing on the bottom line. So if you look at that, sure, you can look at that, you can read that in the newspaper, and you can say, gee, doesn't sound like Microsoft is a great investment at the moment. But is it? So let's just look at Microsoft. And this is basically what the headlines sort of show you. So the headlines scream that Microsoft's revenues are slowing down, the rate of growth is slowing down, and the rate of growth in profits growth is at the slowest pace in years. And that's absolutely quite correct. If you look at the chart on the right, Microsoft's profits are growing at 12%. They're still growing at 12%, better than mine. It's not that they're negative, they're not contracting, they're only growing at 12%, despite all the headwinds that Microsoft is facing at the moment. And yes, its revenue is slowing down. Oh, sorry, see that? Its revenue is slowing down. Parts of its business aren't growing at all at the moment, and that includes the Xbox and Windows software and things like that. But other parts of its business are growing very, very strongly. And that's because Microsoft, if you think back to when Microsoft started, most of you will probably remember MS-DOS. That was their very first product, Microsoft DOS, this operating system. And Microsoft is unrecognizable from what it started off as in that garage with Bill Gates. I mean, it's diversified. It's diversified into Windows. It's diversified into Office software. It's diversified into cloud. It's diversified into gaming. It's diversified into all sorts of different things, because that's what you're wanting Microsoft to do. You're wanting them to spot the opportunity out there and to use their balance sheet and their brains and their brilliance and go and seize that opportunity for you. And so if we just go on, Microsoft, you can see, oh, there's high interest rates, things are getting tough. Microsoft has a net cash balance. So it does have some debt, but it has much more cash than it has debt. So it actually has good, sorry, it has $30 billion more cash than it has debt. That's a very nice position to be in. I wish we were all in that situation. And the implication is that far from this being a drag on Microsoft's situation, they are earning interest on this money for the first time in 10 years because interest rates have been non-existent up until now. So it's actually a boost to their situation. And if you just look at the chart on the right-hand side, this is quite a technical thing. Free cash flow is really a term that describes how much cash the company has left over after it's done its capex. So you can say, oh, well, you can boost your free cash flow by not doing any expansion. But back in 2016, Microsoft was spending $1 billion a quarter on expansion. Today, they spend $6 billion a quarter on expansion, and yet their cash flows have never ever been stronger. They're at record levels. And so from our point of view, it all comes down to what's happening to Microsoft's dividend and earnings, and are you at risk from that? And the other nice thing about Microsoft is that they only pay out 30% of their cash flow, the chart on the previous slide, as dividends. 6 years ago, that was 50%. Now it's only 30%. So if you look at the chart on the right, which is Microsoft's dividend, and Microsoft's dividend has grown by 10% a year over the last 6 years, there's absolutely no reason for us to doubt that Microsoft is not going to continue growing its dividend. Despite all the headwinds that it's facing, all the analysis that we do points to the fact that Microsoft, things have to go absolutely completely pear-shaped before Microsoft is even going to consider cutting its dividend. And that's really what's so important, because the red bars here on the chart are the times when Microsoft share price has delivered a negative return. But if you are living and concentrating on the blue bars, you don't have to worry about the red bars. You don't have to worry when Microsoft's share price falls by 20%, because that's just what markets do, and we can't change that. What we can change is what happens to the blue bars, or what we can influence. We can invest in companies that have the profile of the blue bars, and it doesn't matter what happens to the red bars. So that's really the Harvard House philosophy in action. And I want to bring it home and talk about another little company that hopefully most of you will recognize. It should be in quite a lot of your portfolios. It's another little company called Eppimex. So Eppimex has been around quite a long time. They listed just before the World Cup. And back in those days, they really did aggregates and stone and sand for roads and things like that, and a little bit of concrete products, making curbs and a few other concrete products. But they recognized pretty early on, Eppimex, that in order for them to grow, they were going to have to do things differently. And Eppimex is a little company that's basically defined itself as being a specialist in open cast mining. So whether you're digging sand or stone out of the ground to put on a road, or whether you're digging iron ore or coal out of the ground, it's the same technical expertise, the same set of skills to do open cast mining efficiently with a proper plan and the least possible cost. And so Eppimex has expanded over the last couple of years. And if you actually think about what's affecting Eppimex, it's a pretty grim set of circumstances. I mean, there's not a lot of infrastructure investment in the country. It's obviously a weak economy here. There's volatile commodity prices. We've got an unreliable service from Transnet. We've got an incompetent Department of Minerals and Energy. We've got a very toxic labor relations environment in this country, and obviously, especially in the mining industry. And on that point, I just want to say that Eppimex hasn't had a strike in its operations for about 15 years. They have an absolutely amazing approach to empowerment, to staff development, which really should set the example for a lot of other companies. It really is absolutely fantastic. And that's down to the management of the company. So Eppimex has been steadily diversifying. Even 5 years ago, 60% of their profits came from concrete products and aggregates, roads and sand and soil and all that kind of stuff. And over the years, they've been steadily diversifying because they recognized that if they were just going to rely on one thing, they weren't going to grow as fast as they could grow. And it's a dynamic management team, it's an entrepreneurial management team, and they were keen to see their company grow. And this chart on the right comes from Eppimex, but it basically highlights the difference. The green line basically shows what the profits from Eppimex would have been if they hadn't done any of the growth and acquisitions that they've done over the last 10 years. And the red line is reality. That's what the profits have been, the red line, versus the green line, which was what it would have been had they not made the changes that they've made. And again, we want to reiterate that this was exactly the reason why you have investments, and you invest in companies with good management, because they go and source those opportunities, they go and look for it, and they go and use your money as shareholders and make wise investment decisions with it. So I just want to really take you through a scenario here. Back in early 2021, iron ore prices went to $250 a ton. Now, Eppimex in 2017 bought an iron ore mine in the Northern Cape. It came out of business rescue. The previous owners, it wasn't a bad ore body, but the previous owners just couldn't mine it properly. They were inefficient. They didn't run their machinery well. All things that Eppimex does do well. And then iron ore prices obviously spiked and went through the absolute roof for a whole lot of reasons. There were issues in Brazil, there were transport issues, there were issues in China, and iron ore prices just took off. But now iron ore prices of $240 a ton are completely unsustainable. They should never have got there. And you can see right now that they're back at $80 a ton, which is exactly where they should be. But the consequence of having iron ore prices that high was that Eppimex, in the period of 6 months to last August, to August 2021, made records amount of profit. They absolutely pointed because iron ore prices were at record highs. But everybody knows that that was not sustainable. If you were extrapolating that into the future, you were crazy because it wasn't sustainable. So basically, when they reported for this 6 months to August 2022, this is how their profit unfolded. They started off with 582 million. And just because of the fall in iron ore prices, their profit would have dropped 310 million. Lower profit because prices have come back down to earth. And then there's a further 57 million of lost profit because of higher diesel prices to run all the machinery. So if Eppimex had done nothing and they just sat on their laurels and said, oh, well, it is what it is, we can't do anything about it, they would have gone from reporting a profit of 580 million rand for 6 months down to 220 million rand. And that would have had a consequence, obviously, on the earnings and the dividends. But Eppimex over the last 5 years has been laying the foundation for growth business. And it has been investing in coal, in other iron ore mines, and obviously in its other businesses, its quarries and everything as well. It hasn't just been sitting on its laurels and doing nothing. And all those other initiatives have started to come through. So instead of profit falling from 580 to 220, yes, the profits fell from 580 to 512, but that's a manageable decrease. And you're not, and basically this record bonanza that they received when iron ore prices were record high, they've actually replaced their cash flow and that profit with other operations. So if you look at the earnings, yes, Eppimex earnings have come up a little bit from 550 cents to 500 cents. That's a consequence of iron ore prices coming down to earth. But if you look at the dividends, because Eppimex is such a well-run company, they have no debt, they have cash on the balance sheet, it's a very conservative management team. They only pay out a third of their profits as dividends. They don't pay out all the profits as dividends. They can easily absorb the odd fluctuation, and the dividend is unchanged. If you look at the dividend history over the last 6 or 7 years, you can see that generally the dividends grow pretty steadily from period to period. And yes, the same issue at the bottom here. Eppimex share price fluctuates with the market and the sentiment. Every day it moves up and down. But if you're living, the whole point is that if you're living off the dividends, you don't have to worry about the red numbers. The red numbers are actually irrelevant because it doesn't really matter what the share price does. What it really matters is what happens to the earnings and what happens to the dividends. And that's really in management's control. Now, let me summarize. We're getting to the end. In the US, inflation is definitely rolling over, and there are bound to be a few hiccups along the way. I mean, we had our inflation numbers yesterday, and they were a little bit higher than expected, and the Reserve Bank is even surprised about it. You're bound to have a few little hiccups along the way, and that's going to create a little bit of volatility. But by this time next year, inflation is going to be substantially low. And that's really important because not only is it important for interest rates, but it actually also starts to improve people's spending power. Because inflation starts coming down, your salaries are growing at a higher rate, and you actually start to get that recovery in purchasing power that we've lost to inflation over the last year or two. Interest rates have risen. The market can already see a time through this cycle where we can see interest rates starting to fall. It's not going to happen yet. The next 5 or 6 months, interest rates are still going to rise, probably the next 4 months. But the market is forward looking about 12 to 18 months. And the market is already seeing a time where we can look through that and say, but I can see in 2024 that interest rates are going to start falling. And let's focus on that. The problem that we're going to have next year is that interest rates have risen really quickly this year, as I've explained, and it might already be too late. I mean, obviously, the pace at which interest rates have increased is going to take its toll, and there's no doubt that the global income is slowing down. And then on top of all that, China is just an enigma. So China can go both ways. China can clamp down, it can continue with its policies, it can start to open up, it could be a massive boost for the global economy. We don't know which way it's going to go, but I have a feeling that it's going to go the latter way because the pressure inside China is building. So all of that, does it really matter? We say it so often in this forum that companies are not countries. I really wanted this presentation to try and illustrate the difference between the big headlines and GDP growth and all the negativity around that. I'm sure there'll be headlines tomorrow after the Reserve Bank raised interest rates again today, and really how it translates into what companies do on the ground. And yes, conditions get more difficult for companies. There's no doubt that Mr. Price, who reported today, is saying, listen, things are getting a little bit tougher, and you know, people don't have as much money to spend, and load shedding is taking its toll. But that is a very short-term phenomenon, and companies get in there and they sort the problem out. They might have to spend a little bit of money initially, whether it's on solar or whatever the case is. They look at the problem, they solve the problem, and they move on. And so you might have a short-term dip in profitability, but actually companies come back stronger and stronger thereafter because they end up generally being more efficient. But the consequence of all of this is that we should expect volatility in markets. And I want to really, that brings me on to my last slide. And the last slide is basically, what if we're wrong? That might sound silly. I'm very, very seldom wrong, as you can, my family will attest to. That's my brother, it's not me. But what I really mean by this chart is there's every chance that the world doesn't go into recession next year. And that might sound silly from all the things that I've told you already. But if we do go into a recession, this is going to be the most well-flagged recession in living memory. I mean, everybody's expecting a recession. And so your behavior is already changing because of your expectations of what's coming. So normally what happens when you go into a recession is that you've had years and years of excess, companies have got bloated, they've expanded, they've done too much, consumers have expanded, they've got too much debt, everybody's been living the high life, and suddenly it all starts to come crashing down. And you have a recession that really just clears out the excesses and lays the base for a sensible expansion going forward. That is not the case this year. The only reason why we're going to have a recession possibly is because the US has raised interest rates so aggressively. And yes, it doesn't help, obviously, the energy crisis in Europe and the fact that energy bills are so much higher. But even those have moderated remarkably over the last sort of 2 months, you know. So the market, you have to remember, is really forward-looking. The market looks 12 to 15 months ahead. And I just really want to point out the chart on the right-hand side there. So this is the market. This is what we've done this year. The blue line is the US. The red line is us. And you can see that actually in January, February, things started on a pretty positive note. It was actually going to be quite a good year. And then Russia invaded Ukraine, and markets went south. So if you look at South Africa, from the peak in late February to the very weakest point in early October or the end of September. And remember, at the end of September, it was when the UK was falling apart. They were having more governments than we had, and you know, the sentiment around the world was really, really at rock bottom at the end of September. That difference between the end of February to the end of September was 16.5% in South Africa. That's a big drop. But in the last 3 or 4 weeks, we've recovered all that, and the market is, well, not quite all that, but the market is flat for the year. And the biggest risk is not that there's going to be a recession. Actually, the biggest risk is that there's not going to be a recession because it is so well flagged. Even on the probabilities that we read through in all the economic research, the probability of not having a recession is probably 50-50. So it's by no means a dead cert there's going to be a recession. And if there's not a recession and markets start to look through next year and into 2024, you can have a very, very strong market reaction long before the news starts to turn more positive. And that's the real danger of trying to be too conservative, trying to time the markets, saying, oh, I think there's a recession coming. Let me sit on the sideline for the next 3 months, 4 months. Because by the time you read in the paper that the good news is starting to happen, the market has already recovered at 10 or 15 or 20%, because markets are so forward-looking. And we're not looking at News 24, we are looking at all the companies and doing all the research underneath it. And that's essentially what the market's doing. So I really want to leave that thought with you, is that next year could be a pretty gloomy year. And I think if you read the news you could get caught up in a whole wave of negativity. But I think you need to separate what's actually happening in the economy and what's happening at company level, and bear in mind that yes, there might be a recession. A recession is actually technically 2 quarters of negative growth. The US might not even get into a recession. The growth might slow down, but even my slide earlier, the US is not going into actual negative growth. Yes, England might be, and Europe might be, but they will start coming out of that by the 3rd quarter of next year. So it's quite right to be wary, and I think it's quite right to be aware of these things, but don't let all the negativity and all the news fool you. It actually might not be as bad as you think it's true. So maybe just in closing, I just want to thank everybody for coming. It's been an interesting year. I mean, I was at my kids' school the other day, and I had to make a speech to the board, and I was just saying, maybe the only thing that we've learned over the last couple of years is to expect the unexpected. So whatever 2023 brings, bring it on, because we can cope. And maybe I should touch wood, because we don't want maybe another year like this year. But 2023 is going to be a new year. It's going to be an interesting year. But don't panic, because I don't think that necessarily things are as bad as they seem out there. Even if we are going into a recession, it's not going to be a deep recession in our opinion. So thank you very much for coming. Please stay and join us for some snacks and some drinks. Have a wonderful Christmas, and we'll be here in the new year to do it all again. Thank you.